Let's continue our conversation on rate of return. This is part three. So you can go back and watch parts one and two to see how we set it up, looking at using both market based assets and whole life insurance and comparing and contrasting how they might perform as part of a retirement scenario. Just for review, we're going to go back over the summary of results very quickly. So by investing in the S&P 500 over a 30-year period from 1994 to 2023, and also taking some money out to have term life insurance coverage during that time, you invest a total of $689,000 and you end up with a $1.4 million value in your investment account. Accounting for taxes, fees, the cost of a term life insurance policy, and the sequence of returns, your net rate of return is 4.4% over 30 years in the market. But in retirement, what matters is not the size of your nest egg, but how much income can you safely generate? How much income can we get out of our market based asset when we retire? How much income can we safely generate from our market based account? The 4% rule is something that's been come up through a lot of Monte Carlo simulations and other analysis. The basic answer is if you have money at risk in the market and you want to be sure that money does not run out, you cannot safely take more than 4% out of that market based account every year in order to avoid running out of money. There's about a 90% chance you will not run out of money before you run out of life with a 4% withdrawal rate. From our market based assets, as long as we keep our distributions to 4% per year or less, there's a 90% chance we will not run out of money, but it's not guaranteed. Depends on how the market performs. So our approximately 1.4 million that we ended up with in market-based assets can safely yield 4% or about $55,000 a year in income. If we look at a 20-year retirement lifespan from when we retire at age 65 to age 85, we'll take $55,000 per year for 20 years. That's a total of 1.11 million in income over 20 years. After we take that income out of our account, how much is left in the account? Well, we don't know. That depends on how the market performs. We're only distributing 4% to make sure our money lasts. How much do we have left in the account? We don't know. Depends on market performance, depends on sequence of returns. Even if we get the returns we're hoping for over the long run, when those returns happen is very important. A downturn in the market early in retirement hurts us a lot more than a downturn in the market late in retirement. So that market risk adds uncertainty. It adds the sequence of returns risk. 1.4 million in a market-based account can safely yield about $55,000 a year in income. And it's pretty likely we won't run out of money, but it's not guaranteed. Let's contrast that with whole life insurance and let's review the results we saw in part one. With whole life insurance here, we're putting in a total of $725,000. The reason why we're contributing more to whole life insurance is because we don't have the cost of buying a term life insurance policy because whole life insurance comes with a death benefit that protects us. We build up $1.7 million in cash value and a $2.9 million death benefit by the time we retire. Our net rate of return is 5.2% on our cash value and 8.1% on our death benefit. So now the question is, how much income can the whole life insurance policy safely generate? We've already seen that we've accumulated more in the whole life insurance policy. We have 1.7 million in cash value versus 1.4 million in the market-based assets after we account for taxes, fees, the sequence of returns, and the cost of term life insurance, not to mention the $2.9 million permanent death benefit. So how much income can we safely generate from whole life insurance? Let's look at it. With whole life insurance, we can borrow against the policy without taking on debt and without interrupting the earnings in the policy. That means we can safely use the money in the policy without interrupting the interest and dividends we're earning in the policy. And also, because our cash value and death benefit are guaranteed to grow every single year, we're not subject to market risk or the sequence of returns risk. So we can be much more predictable and accurate in measuring how much income we can safely draw from the asset. This is not an either or scenario. You can have both whole life insurance and market based assets. You can use your whole life insurance policy as a volatility buffer. So when your market assets are down, you pause withdrawals from your market based assets and you draw from whole life insurance instead. That can extend the life of your market based assets by at least 10 years. It can increase the distributions you can take from your market based asset. So I'm comparing and contrasting these two, but I want to reiterate it's not an either or scenario. You can do both. There are some unique benefits to investing in the market, like a higher potential rate of return. And then there are some unique benefits to putting money in whole life insurance, like the guarantees, the predictability, and liquidity. We can therefore generate significantly more retirement income from our whole life insurance policy because we can borrow against it without taking on debt and without interrupting the earnings in the policy. We don't have to withdraw money from our whole life insurance policy in order to generate income. In this example, our $1.7 million dollars of cash value yields $72,000 in annual retirement income with no market risk. So, $72,000 a year in income over 20 years gives us 1.44 million over that time frame. Our market-based assets generated 1.11 million over the time frame. Whole life insurance gives us 1.44 million over that time frame. And how much is left in our whole life insurance policy? After we took 1.4 million out of the policy, we started with 1.7 million in cash value. We drew 1.4 million. How much is left over? 2.1 million. That's how much cash value we have left in our whole life insurance policy after we took all that income out of it. We have more cash value than we started with after drawing all of that income. That's because we did not interrupt the interest and dividends we're earning in the policy. So all of our cash value keeps earning for us if we're simply borrowing against the policy rather than withdrawing from it. So whole life insurance can safely generate more income than market based assets. Now, obviously, if you want to take on more risk, it's theoretically possible your market based assets could generate more income. You could withdraw 10 or 12% per year out of your market based assets. And if the market is giving you 18, 20, 24% returns over that time frame, then you could safely do that. But there's no guarantee you're going to be able to do that. And especially over a 20, 30-year time horizon for retirement, that will be putting your portfolio at risk. Summarizing here, this is a slide I've shown in another presentation, but this is just summarizing the scenario with whole life insurance. We paid $725,000 in premiums into our policy over 30 years. That gave us 1.7 million in cash value by the time we're done paying premiums and a $2.9 million death benefit. Then we draw that income, $72,000 a year over 20 years, for a total cumulative income of 1.4 million. Yet our cash value rose from 1.7 million to 2.1 million while we're drawing income. So our cash value rises even as we take income. That's because we're being strategic about borrowing against the policy and not interrupting the earnings in the policy. And our death benefit is roughly the same, 2.9 million. And there I'm showing you some of the parameters. The gross cash value is actually 4.7 million at age 85, not 2.1 million. I'm showing you the net cash value, but remember, we're borrowing against the policy. So the gross cash value is actually much higher. And same thing with the gross death benefit. It's actually higher as well. So again, whole life insurance is a two-dimensional asset because of the policy loan feature. We can leverage the asset, we can borrow against it without taking on debt and without interrupting the earnings in the policy. That's one of the reasons why we're able to safely generate more income from whole life insurance than from market-based assets. It's important to keep that in mind. The headline number, the dollar figure associated with your asset, doesn't give you a full understanding of the value of that asset, especially when we're talking about income generation with a seasoned whole life insurance policy that's been enforced for multiple decades. There's a lot more you can do with it, and the dollar figure associated with it doesn't necessarily show that, but this shows you more of it. We had 1.7 million in cash value, yet we were able to draw 1.4 million in income out of that policy without taking on any market risk or paying any taxes. And then we're left with 2.1 million in cash value, not to mention the same $2.9 million death benefit. And lastly, just to summarize the comparison, market based, you're taking $55,000 a year. That's 1.1 million in income over 20 years. After taking that much income, how much is left in your market-based account? Well, we don't know. It depends on how the market performs, depends on sequence of returns, other things like that. With whole life insurance, we're able to take $72,000 a year. That's 1.4 million in income over 20 years. And how much is left over after we take all that income? $2.1 million dollars in cash value. So we have more cash value than we started with, not to mention the $2.9 million death benefit that was protecting us the whole time. There are quite a few other benefits that whole life insurance gives you. One of the biggest in retirement is protection against long term care. I could have subtracted from the market based investment premiums paid into a long term care insurance policy, because if we want to equalize these two, we have to account for that. Paying for long term care can put a big hole in people's retirement plans. There's about a 70% chance that you or your spouse will need some form of long term care if you both reach the age of 65. Long term care doesn't mean the worst case scenario of going into a nursing home. In most cases of long term care, the insured still lives at home, but they need extra help. They need to redo the house. They need a nurse to come over and take care of them. They need someone to cook for them, things like that. With whole life insurance, you can use that death benefit. Remember, we still have a $2.9 million death benefit at age 85. We can use that death benefit if we have a chronic or terminal illness. And that is a huge benefit to whole life insurance that we're not even accounting for here. If we wanted to make it even more of an apples to apples comparison, we would have to subtract more out of the market based asset to pay premiums into a standard long term care insurance policy. That's just one of the many benefits that whole life insurance can give you. That death benefit also accounts for legacy. We're not worried about what we're leaving to the children and the grandchildren. We've already accounted for that in the death benefit on a tax free guaranteed basis. That means we have permission to spend down our assets more aggressively, knowing that when we die, that death benefit will account for legacy. But this is just showing you how the guarantees and the policy loan feature in whole life insurance mean that we can generate more income from a whole life insurance policy than a market based asset. This is not intended to be an either or scenario. You can do both. And most people, in fact, do both. They'll have a whole life insurance policy and they'll have some investments. It might not be market based investments, it might be investments in real estate or business or other more speculative assets. But typically, people are going to do both. But this shows you the multifaceted use of whole life insurance, how when we view it only as an investment, it's harder to measure the benefits it's giving you because whole life insurance technically is not an investment. But when we look at things like the guarantees and the income generation, we can see a lot better the benefits of whole life insurance, particularly in retirement.